When it comes to investing, products in equity and debt gold are largely known to investors, but there's one category that is lesser discussed, and in fact, more than one. We're talking about REITs, InvITs, and alternative investment funds. On the Money Show today, we will shed more light on these investment products. And with me today is Alok Saigal, President and Head Nuvama Private. Alok, good evening and welcome to the Money Show. We are talking about very innovative investment categories which not only provide the benefit of diversification to your portfolio, but also if you are an investor who's got a core and a fundamental portfolio laid down, you can definitely look at these investment products. So Alok, let's begin with REITs because we will not club these investment instruments. Talking about REITs, I think we have 4 to 5 REITs listed in the country. So far, what has been the response and what's the nature and the feature of this investment product? If I could just start with a very basic question.
Sure. Thank you. Firstly, thank you for having me on the show. So I'll give you a quick brief on what you asked. So REIT is basically a real estate investment trust, and this is giving retail investors and obviously HNIs and ultra HNIs access to commercial real estate in a manner that they don't need to own the property, but they can get returns from commercial real estate. The nature of income, basically any commercial real estate property in India is then leased out to grade A lessors, and these are all rent generating assets. But the end investor basically gets distribution in its hand, also in the term of dividend and an interest income that these REITs are generating. So basically, these are pooled vehicles which are ultimately buying out grade A real estate assets. So this is a fairly basic answer to the question.
What kind of assets do actually REITs invest into? Are we talking about residential property? We are talking about commercial property?
So in India, so far, we have 4 to 5 real estate investment trusts, and all of them so far have all been on commercial real estate. So if you see, there is an Embassy Real Estate Trust, which is earlier it was the Embassy Group and Blackstone, which launched this trust, and now there are other private equity funds also owning it along with the Embassy Group. This is largely commercial real estate. Again, the second one was Mindspace, which is there are private equity, but again it is promoted by the Raheja Group. Again, it's a commercial real estate, and the third one also is all on commercial. So currently, all the REITs that have come out in India are largely on commercial. We have one trust which has come out recently, which is a Nexus Select Mall Trust. That is a trust which has come out for retail assets, which are the mall assets, and they have a portfolio of mall assets. But currently, there is no residential trust in India. Offshore, globally, if you see, REIT is a very, very large asset class. And there we see a mix of, commercial, mixed use, residential, etc. India is evolving, and India has seen rapid development of this asset class. And I am very confident, and we are very confident that over the next few years, this will actually we will see more development and growth of this segment so far.
So the asset class, no doubt, has a promising future, especially if you're using it for diversification. But then this route of investment in this asset class is still not known very much. What do you have to say? Why hasn't it really picked up since the time REIT has been announced as an investment product? So far, when it comes to the understanding of the product, and also, is it something that retail also can participate, or is it just an HNI restricted investment product?
So it is traded. So I'll answer the second part first. Sure. It's traded and listed on the exchanges. So it is, the unit value is, they starts with, 100 rupees, 200 rupees, 300 rupees, depending on the net asset value, like a mutual fund. So retail can participate. It's freely tradable on the exchange. But you are very right. Somehow this asset class has been more popular right now with, the HNI and ultra HNI community, and not so much with retail. So I think the reason for that is that the underlying yield on these assets has to be seen like a AAA fixed income asset. So the underlying yield on the REITs is between 6 to 7%. and the post tax, because it's a combination of dividend and interest income, the post tax yield is coming between around 590, in some cases 580, 590 to 6%. Now that may be for retail, and especially people in the lower tax brackets, there may be other options also available which give them a similar post tax yield. And the second is that using to buy this product, obviously you need to go through a broker, or you have to go through the exchange. So you need to have a demat account and a broking account. So that is the second reason. My thing is that the first reason may be more uh, prevalent, that the fact that the post tax yields are still lower for the retail investors. But when you look at the HNI investor, he is in the highest tax bracket. For him, a 6% post tax yield is actually a very, very good. It's like a 10% pre-tax. So I think it's from a segment point of view, that is a reason. But I definitely feel that this is an asset class which will get more popular.
Minimum amount of investment required in a REIT, Alok?
Sorry, I didn't
What
get
is
that.
the minimum amount of investment?
So if you are doing the publicly traded REIT post listing, you can buy one unit, which is, so if you buy an embassy today, it's 300 rupees per unit. It's like buying a share. You can buy one share of the REIT. If you're looking at the private REITs, or the which are not listed on the exchange, they have a minimum cap of 2 crores. So they have a gating of 2 crores for that. But for the publicly listed, the retail, anybody can buy. It's the minimum unit, like it's like you're buying a share. So you can just buy one unit. So that is not a challenge.
All right, let's move on to the other investment product, which is in REITs. And how different is it from REITs, and what would be the product feature?
So India as a economy, or India as a country, has actually bifurcated two different asset classes. So REIT is largely the real estate investment trust, and InvIT is a specialized vehicle which invests in infrastructure assets. So globally, if you see, it is one asset class, and product-wise, there is no actual difference in the features. India as a country has actually done a specialization of InvITs. Today, India has more InvITs than REITs. So you have 5 REITs and maybe 20 InvITs that are there in India. And these are, very popular, from from public sector units to, some road-based assets, toll-based assets to, other infra assets. So largely these are either transmission assets, public sector assets, or these could also be road-based assets. This is specifically been, a more popular category because a lot more, assets have been made available, and government has also used it as a tool for, divestment or raising funds. We have seen NHAI raising, an InvIT. Power Grid has done an InvIT for their transmission assets. So it's also good monetization tools. So from a state of the economy where India is, this is possibly both. It allows people to participate in yielding assets, but it also gives government, and it's a good road for funding for infrastructure assets. And that is actually one big difference. That's specifically for infra. Secondly, again, the nature of underlying asset is different. These are more long term. So a commercial asset is, from day one, it is yielding. Similarly, a transmission line, when it's built up, it will yield an annuity. So from the underlying nature of income, they're very similar, but the technical classification of income may be slightly different. In one case there may be more dividend coming or interest income coming. In infra assets, again, the classification may be different, but fundamentally they're the same. There is not much difference between the two assets.
Retail as well as HNI can invest in it?
It's the same. So it is the same retail and HNI, same privately held in which it's a 2 crore criteria, and the publicly listed, like a Power Grid, is trading around 117, 118. So you can buy one unit for that. So it's the same actually. There is no difference from that point of view.
Even the taxation is the same?
Taxation is again similar. Okay. So the taxation, Kavita, is actually done in 3 formats. So there is an interest income that is at the maximum marginal rate of the individual, or whoever, whatever the nature of the investor is. The dividend, again dividend has a 2 nuances. So if it is a trust before 2017, the dividend at the old SPV is actually tax free at the hands of the investor. The dividend is taxed at the hands of the trust. If it is a new trust, which some of these are, then the dividend is also computed at the hands of the investor. And then there is a capital return criteria, which is computed as a capital gain minusing the cost of capital. But the taxation fundamentally is actually similar for both of them.
Let's move on to alternative funds, and this is one category that's gaining traction, and we're also seeing the regulator coming up with newer guidelines to make it more investor friendly. So, in terms of guidelines, what's new, what's changed, and how has it become investor friendly, and who can invest?
So I'll start with who can invest. So
Sure.
the AIFs have a gating of by the regulator of minimum 1 CR. So therefore, they have tried to put that it's a slightly sophisticated investor. So the minimum gating is 1 CR for AIFs. The second difference is that a lot of space has been vacated in asset classes like credit by mutual funds and in some cases even by NBFCs. So we are seeing that specialized funds have got created for participating in credit opportunities, in venture capital, distress opportunities, and various types of AIFs have come in. So these are a lot more specialized opportunities that sophisticated investors can actually participate in. And I think that is where there is a big difference and there is a big growth of this category. So today, the AIF category in India for Cat 1 and Cat 2 has crossed almost 7 lakh crores, which is, has been seen a growth of at least, if not more, a 10 times growth in the last 6 to 7 years, which is a significant growth. This category has also become very popular for people who are, chasing yield. And I think that is where the fundamental interest in this category lies. So people who are looking at higher yield earlier were going to mutual funds, etc. But that category in mutual funds, especially after the taxation, has completely changed. So therefore, there is a clear benefit of this category. The other question that Kavita you asked was on what has changed. So there are 2 3 changes that have happened. One, SEBI has introduced a direct category like a mutual fund and a PMS. So they have introduced a direct code or a direct plan in AIFs. So that is one change that has happened. Second, they have also made the payment to distributors. So there are 3 categories of fund: Cat 1, Cat 2, and Cat 3. Cat 3 are specifically equity managed accounts, etc., more like hedge funds, etc., and long only equity. So there they have said it has to be an all trail model like a mutual fund or a PMS. So that is so they've made it on par. They made all the 3 categories on par, and I think it's a very, very good step. For Cat 1 and Cat 2, what they have said is any distribution commission that is there, a part of it, roughly 1/3, can be paid upfront, and the rest has to be made paid as trail over the life of the fund. So that is because earlier these category of products had a higher, commission or paid upfront. But there's one big fundamental difference which investors should know, that in Cat 1 and Cat 2, the asset management company is paying the commission rather than the investor, which is very unlike a PMS or a mutual fund because there are differential fee categories between direct and the broker code. So here that difference or a nuance is there, and this is a long-term product. So these are almost 10-year products. The distributor also has, or the advisor has to do a fair amount of work, in getting the drawdowns, because these are all drawdown-based products, to get the drawdowns from the investors, etc. So it's, I think, a win-win, and this will further strengthen the industry, in my view.
All right, I think my time is up, and we've got a basic structure of these 3 investment products. I'm sure a longer discussion is needed for this, but then that will be for later. Alok, thank you so much for being on the show today, helping our viewers with these very innovative investment products.
Thank you, Kavita. My pleasure.
Thank you. And on that note, we'll take a quick break. Post that,